I would say I'm a cautious bull now, but I do believe there is a reasonably high probability scenario where I will be a raging bear at some point in 2025. Kind of our general expectation is that, sometime by late Q2 or early Q3, we're probably going to be engaged in a significant drawdown in asset markets.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Darius Dale, founder and CEO of 42 Macro, has had a remarkably impressive track record in correctly forecasting the markets over recent years. Having turned bullish at the start of 2023, he remains so ever since, helping his subscribers successfully ride the wave of ferocious back-to-back annual returns of over 20% in stocks. He also helped them catch Bitcoin's price doubling over the past several months. So, here at the start of 2025, where does his model see markets going next? Should we expect more of the same, or is a trend change in store? To find out, we'll talk to the man himself. Darius, thanks so much for joining us today.
Such a great pleasure to be here, man. I'm so grateful to be here.
All right. Well, Darius, look, so much to talk about. Kudos again for the wonderful performance you and your hardworking team there at 42 Macro have put in. Folks, real quick, just a housekeeping note. We're going to have a great discussion here today. Darius's next appearance on Thoughtful Money is going to be at Thoughtful Money's spring online conference on Saturday, March 15th. Haven't officially announced it yet, but since Darius was here today, I thought I'd give you all the advance warning. Details to come out soon, more details to come out soon about how to buy tickets and everything and who else will be participating. But right now, just mark your calendars. Saturday, March 15th. That's our next big online conference. All right, Darius, well, look, just to recap again real quickly, in your past couple appearances on this channel, you have just continued to hit the ball out of the park again and again and again. A little over a year ago, at November of 2023, at the end of a surprisingly great year, right? Everybody started the year thinking that it was going to be a recession and kind of Armageddon. Turned out to be a great year. I think it was November of 2023 you came on and I asked you, Darius, are we getting ahead of our skis now here, right? And you said, I don't think so. In fact, I'm about the most bullish I've ever been. We then went into 2024, which was another amazing up year. So kudos for that great call. When you were on in the summer, you mentioned you were still optimistic that this party still had more room to run. That was a correct call. When you were here a few months ago at our fall online conference, I asked you, okay, look, is this thing beginning to run out of steam, Darius? And you said, no, we've actually just, after a little wobble, looking like we might dip into disinflation, we're back in Goldilocks, and for the foreseeable future, the dip should be bought. Again, the right call. So as we begin a brand new year here, can this train keep running or not? So what is your current assessment of the global economy and financial markets?
Yeah, thanks again for having me, man. And really appreciate that warm introduction, man. Definitely helps us grow our reach and the number of people that we can help retire on time and comfortably with our research. So I'll start by saying it's obviously been a great run. And we are now, as a function of that great run, we're at a very asymmetric point in the positioning cycle. A lot of investors generally speaking, are kind of on one side of the boat, the bullish side of the boat, with extreme bullish positioning across a variety of indicators. And so as an investor, when you think about this in risk management terms, you have to kind of really be focused on, okay, what could potentially go wrong and cause some of that positioning to unwind? Because I think it's pretty clear what the drivers of that positioning were. It was the persistency of our resilient U.S. economy theme. It was the persistency of our Jay want the soft landing theme, whereby the Fed had this asymmetrically dovish reaction function that was supporting the expansion of risk asset valuations, et cetera. And so are those things going to become less true? Or are we going to get barraged with, the advent of new themes or the waking up of old themes that have sort of become dormant? I think about our sticky inflation theme in the latter category, and I think about our triple S's theme in the former category, specifically as it relates to the size, sequence, and scope of the potential fiscal and regulatory policy changes we're going to see out of DC. Right. If you think about what we're going to see this year from a fiscal and regulatory policy perspective, it's going to be a lot of things. But there are 5 major sort of categories that the Republican Party have outlined as their main policy agenda of this year. There's obviously tax cuts being the most number one thing. There's deregulation and there's accelerated energy production. All those 3 things are positive for both the economy and asset markets, and they ultimately should result in a positive supply shock in the economy, which obviously is supportive of corporate profit growth. There are negative things, however, that are likely to offset that. And the size and sequence of those negative things could either create significant problems in asset markets, or they could create, sort of relatively minor problems in asset markets. And then those are obviously tariffs being the kind of the biggest issue there. And then this sort of, concept of securing the border and reducing net migration flows into the US. So those two things could create a negative supply shock in the economy, support inflation higher, and ultimately cause some problems in asset markets through the lens of potentially tighter monetary policy, a hawkish move, a continued hawkish move in interest rates, and ultimately more dollar strength, which if you have those three things or those two things continuing, you could potentially wind up with a global refinancing air pocket. So kind of summarizing all that, this is a year in which, we generally think investors, probably will, get some sort of positive return out of the market. However, I do believe there's a I wouldn't say high probability, but a reasonably high probability scenario whereby the market crashes in 2025. Now, I don't think this is the beginning of the end of the secular bull market. I do believe even if the market crashes here in 2025, the dip will be bought. You still have the AI super cycle ongoing. You obviously have tax cuts and deregulation that are coming down the pike. So I don't believe that if we did see a significant correction or crash in the stock market and across risk assets in 2025, I don't believe this is the start of a multi-year or even a multi-quarter type process, but it could just be a rinsing out of all that asymmetrically bullish positioning because we don't get enough, good news to support that positioning in succession. So that's kind of where we can unpack any element of that, but that's kind of where we are for right now.
All right. So I've got a lot of questions for you on this. I think it's just important to note shift in tone from when you've been on this program
Definitely.
multiple times before, and I already
100%.
kind of gave the summary, but you were, I would say, very sort of optimistic, sanguine about the road ahead. I detect a lot more concern in your voice here. So
Yeah.
again, just to underscore it, you're not calling for like a secular trend change from a bull market to a bear market, but you're saying there could be a really big air pocket this
Yeah.
year, and that could catch a lot of people by surprise, obviously. And then there's still, looking at the road ahead, there is more murkiness, more uncertainty than you've had in past years, and a lot of that's because of these policies. We don't yet know which of them are going to get implemented to how much. So there's going to be sort of a wait and see element of this year as well, correct?
Absolutely, 100%. And again, the reason this is an issue is because the positioning cycle is so asymmetric, right? You think about, coming from a year where, in 2023 we were bullish, 2024 we were ragingly bullish, and so a lot of positioning has been, part of that, being bullish at in those intervals is we saw the positioning cycle was not as bullish as we were, and so we knew that, one by one we had to suck investors into the dance. You got to pull them
Yep.
off the ball into the dance floor. And now everyone's in the middle of the dance floor expecting a lot of good news. And I guess the key takeaway for 2025 is, probably going to get some good news, but there's a reasonably high scenario, reasonably high probability scenario that the bad news comes first. And we get a significant amount of bad news concentrated, let's call it in the first half of the year or maybe in the middle part of the year that could create a air pocket in asset markets. And, I think of, Q4 of 2018 as a perfect example of what an air pocket in asset markets. We had a crash in the S&P 500 in Q4 18, obviously had a significant drawdown in crypto assets and other risk assets as well. But ultimately that dip was bought and we had a significant recovery in 2019, all the way into the February of 2020 leading into the COVID crash. And so that's kind of the general, framework that we're operating with as investors right now. In terms of how we think about managing 2025 risk. That's our general expectation. Now, 100% of that could be wrong, right? We could just maintain this raging bull market. This could be the start of a secular bear market. There's a lot of things that could be wrong about that general assessment, but obviously we're incredibly data driven with each of those comments that we made. So if you want to unpack any of them in order, Adam, I'm more than happy to.
All right, and we'll get to your data in just a minute because I know folks know you're on the channel, on the video, and they're like, okay, when are we going to see all of Darius's charts?
Let's do it.
They're coming, folks. But real quick, so would it be fair to categorize you as rather than a raging bull, like you said you were heading into 2024, maybe a cautious bull, like you're still kind of bullish on net, but you're much more careful about how it's going to play out this year?
I would say I'm a cautious bull now, but I do believe there's a reasonably high probability scenario where I will be a raging bear at some point in 2025. Now, I don't expect to be a raging bear, from that point all the way through, let's say, well in 2026 or and beyond. I do believe it will be a quote unquote transitory period of bearishness, but this is a potential period of bearishness in the middle of the year. That's kind of our general expectation, is that sometime by late Q2 or early Q3, we're probably going to be engaged in a significant drawdown in asset markets. And it'll be very appropriate for investors to manage that risk, in so much that it'll be very appropriate for investors to understand that even if we did crash in the middle of this year or even before this, you still would be wanting to you have some dry powder available to potentially buy that dip, because we don't think the secular bull market associated with the AI super cycle and associated with what's likely to be, corporate tax cuts, household tax cuts, deregulation. We don't think that those things are we don't think we think those things are likely to continue to contribute to the secular bull market, but we could take a potential pause. Is what we're essentially saying. Imagine being on an airplane, we're flying 30,000 feet in the air, and all of a sudden we hit turbulence and we drop like 10,000 feet, right? The plane didn't crash, we didn't land, nothing bad really happened, but we all got freaked out for a second, right?
Yep.
And I'm expecting a pretty significant freak out in 2025 associated with the advent of our more negative themes kind of coming true. In fact, I'll share my screen here to kind of give you an indication of that. So this is our fundamental research summary. We update this in all of our research reports. It doesn't change very much, but obviously it only really changes when we get incremental data that kind of changes our conviction in a theme, or just changes the theme outright, or our forecast change in a material enough manner to get rid of a theme or add a new theme. But the reality is, when you kind of think about what has contributed to all that bullish positioning that we keep alluding to, it's been our resilient U.S. economy theme, which we authored in September of 2022. That was, that became true in the eyes of investor consensus. That's something you and I have been talking about for almost 2 years now, Adam, or
Yep.
at least 18 months now. Our J1 to soft landing theme, which we introduced in November of 2023, which was contributory to me saying I'm as bullish as I've ever been in my career. This is a Federal Reserve that had an asymmetrically dovish reaction function, which you go back and you study, central bank reaction functions. Anytime it's asymmetrically dovish, you typically see a significant expansion in asset valuations. That's exactly what we saw in 2024. So that was correct. Now, these themes are now becoming latent. Growth is starting to slow. The Fed's reaction function is not as asymmetrically dovish. And oh, by the way, we now have this new theme called our triple S's theme, which we alluded to, regarding the uncertainty around the size, sequence, and scope of the potentially dramatic changes in fiscal and regulatory policy. We know we're going to get debt ceiling TGA spin down, debt ceiling related Treasury General Account spin down in the first 4 to 5 months of the year. But after that, they're going to have to rebuild the TGA. Incoming Treasury Secretary Scott Bessent, who I know well, is a longtime client. He's been hypercritical of Janet Yellen's preference for bill financing, so they're probably going to shift the net financing policy of the U.S. Treasury in a hawkish manner, i.e. favoring coupons at some point this year. And oh, by the way, our sticky inflation theme, which we've maintained since January of 2022, by the middle of this year, if you look at our forecast, it's going to become more consensus in our view. And so, we got an economy that's getting less resilient, a Fed that's getting less dovish, inflation that's getting more sticky. And oh, by the way, there's a lot of change from a fiscal and regulatory policy perspective. And some of that change is explicitly very bearish for asset markets, especially in the context of where we are in the positioning cycle.
Okay. God, so many questions. First off, I just don't want it to go unnoticed by the listener. You just said that new Treasury Secretary nominee, Scott Bessent, has been a longtime client of 42 Macro.
Obviously not anymore, but yeah.
No, but still, that's just wonderful to hear. I mean, I think it hopefully gives a lot of viewers heart that, hey, somebody's coming in at the helm there that at least has an appreciation for the way that experts like you think.
I think your what listeners and viewers would be very very impressed by our client list. I don't say that. I don't mince words about that. I've cut my teeth on global Wall Street, and what I'm trying to do with 42 Macro is take those institutional insights and create research solutions and asset allocation solutions for Main Street investors. I made plenty of rich people very rich throughout the course of my career on Wall Street, and it's very important for me to make sure that the folks on Main Street, where I'm from, are actually getting rich too, based on my hard work.
Right, which is one of the reasons why I'm such a huge fan of you and 42 Macro. But I think, folks, so let's contrast him with the person currently in the seat, right? Janet Yellen.
Also a Yaley, by the way. You're talking about three Yaleys here.
Okay. But Janet Yellen, a lot of people would say, look, she's business as usual. She's an ivory tower academic. They're all about just what their fancy models say, but they really don't have a lot of application to the real world, and they don't necessarily think of Main Street, right?
Yeah.
Where it sounds like you're saying Scott Bessent, I don't know if you know him personally or not, but the fact that he has followed your work gives me hope that he has a more practical understanding of the way that things work than, say, your standard ivory tower academic.
Yeah, 100%. He's going to have about as practical as understanding of U.S. and global economics as anybody that's ever sat in that seat. I'm incredibly impressed by him as a man and as a person. I think he's going to do a fantastic job for our country. I couldn't think of a better nominee, quite frankly. But the issue is, as it relates to asset markets, if he is hypercritical of her preference for bill financing, which was instrumental in freeing about $2 trillion plus, $2.4 trillion from the Fed's reverse repo facility, and ultimately causing an expansion of the private repo markets. If he's critical of that activity, then ultimately we have to assume that he's going to move in an opposite direction. And if he moves in the opposite direction and starts to favor coupon financing over bill financing at the margins, then you're talking about just a more hawkish dynamic as it relates to the global fixed income markets. You're talking about wider or higher real interest rates, wider term premium, et cetera. And the markets, in my opinion, are already sniffing this out, right? Term premium up about almost 100 basis points since mid-September, contributing about 90% of the rise we've seen in nominal 10-year treasury yields since then. So I think the market is smart enough to have figured a lot of this out alongside us. But the reality is it's just not good, right? Let me show you our positioning model. Our positioning model is this should be very concerning. We use this to assess the probability of significant reversals in momentum across markets over multiple time horizons. And when you look at the positioning model indicators that correspond to the medium to long-term outlook for the market, the ones that'll tell you, okay, we're probably close to a secular top or a secular bottom, a lot of them are already breaching levels that are consistent with major bull market peaks. If you look at the AI stock allocation survey, that's in the 87th percentile, already breaching the median value that we typically see at these major bull market peaks: August of 87, July of 1990, July of 98, March of 2000, October 2007, April 2011, September 2018, February 2020, and January 2022. If you look at the ag bond allocation survey, we're almost breaching that the level to the downside, i.e. investors don't have enough bonds in their portfolio as at those major bull market peaks. Same thing with the cash allocation survey. We're already breaching the low level of cash we typically have at these major bull market peaks. If you look at S&P 500 realized volatility as a proxy for systematic fund exposure in the market, we're close to breaching the level. And then if you look at implied vol correlations as a proxy for market neutral hedge fund gross exposure, already breaching the level. S&P 500 next price to next 12-month earnings per share is in the 92nd percentile, obviously breaching those levels. And then the investment grade credit spreads in the 3rd percentile, breaching the median value we typically observe at these major bull market peaks. So this is a positioning cycle that is quite full. Could it get fuller? Of course, it absolutely can get fuller, but it probably, you probably need more, even more resilient economy and an even more dovish Fed. And those things seem unlikely based on where we are in the growth cycle and based on where we are in the inflation cycle and ultimately how the Fed is going to respond to that.
Okay. Agreed. And, if inflation's sticky and if bond yields are higher than expected, that just acts as greater gravitational forces slowing the economy down forward from here too, right? So to your point of, what would help is if the economy got even more resilient, but it's hard to see it doing so given those two big trends, as well as it's hard to see there aren't too many like surprise accelerants on the near-term radar here. All right, but look, a couple questions I've been wanted to ask you here. One is, if I heard you right, you said, okay, look, there's an uncomfortably high chance that we're going to hit an air pocket at some point this year. There's probably going to be some market correction. I think you used the term crash, but we'll just say, material market correction here. But you're saying you want to probably have some dry powder around because you expect that dip to get bought, and you're not necessarily predicting a multi-year bear market ahead. Let me just contrast that with what I think is still Michael Howell's outlook. And I know you follow Michael Howell's work around liquidity. It's been a little while since I've interviewed him. I'm actually interviewing him in like a week or two, so we'll get the update soon. But last time I talked to him, he had basically said, not too dissimilar. He said, look, he looks through the lens of global liquidity, and it's a multi-year cycle, and that cycle peaks at the end of this year. But kind of like throwing a ball up in the air, the impulse of the rise is diminishing, right? The rate of growth is slowing as you're getting near the apex. So the lift factor on asset prices is going to be diminishing as we go through 2025. So two things. One, so he says, look, I think the easy gains have been gotten in the markets. 2025 might still end the year up, but it's probably going to be a disappointing year for investors who are now gotten used to these tasty 20+% returns, right? But he says it could be even worse than that. And one of the things he's worried about is the global debt maturity wall that's really beginning to roll out in earnest in 2025, because his whole thing is liquidity, and he sees that refinancing of corporate debt at substantially higher rates, like a giant sponge that's going to continue to suck liquidity out, right? So anyways, to whatever extent that happens, so be it. But by his models, at least, at the end of the year, the liquidity cycle changes, and we start going into contraction for several years. So he was like, look, please let me come back on your channel, later in 2025 so I can give you an update. But right now, I'm really worried about 2026 because that's the year I see the tide going out. Do you have a material different view from him because you're expecting to buy the dip, or do you think this buy the dip phase could be something that's only limited to a quarter or two, and then there could be even tougher sledding ahead?
Yeah, I don't know if I have enough, insights on 2026. I've seen some of Michael Howe's work on forecasting liquidity cycle. Obviously, this man is one of the world's foremost experts on this subject. So I certainly want to give him his respect in that regard. But the work that I have seen on his that sort of forecast the liquidity cycle from a multi-year perspective, I generally disagree with, just in terms of my first principles understanding of how to forecast time series. But that is what it is. But in terms of we have a lot of similarity, a lot of overlap with respect to how we're viewing the risk for 2025. So with this chart, and so as you know, Mike, or as you know, Adam, one of the things we do for our clients here at 42 Macro is help them understand really in depth exactly where we are in the liquidity cycle, and sort of relating that back to where we are in the global refinancing cycle, and how sometimes those things might contribute to positive dynamics in asset markets, and other times they could potentially contribute to negative dynamics in asset markets. And so in this chart, we show the blue line is our 42 Macro global liquidity proxy. This is our metric to track global liquidity. We're showing it on a year-over-year rate of change basis. And the global liquidity proxy is the aggregated sum of the central bank balance sheets of the world's 10 largest economies. It's their broad money supply, the aggregated sum of their broad money supply, and it's the aggregated sum of their FX reserves minus gold. It's actually so the world's 12 largest economies and their FX reserves minus gold, and then we added bond market volatility overlay to simulate the impact of the expansions and contractions in the private repo market upon global liquidity. And so we can very clearly see from this chart that the fluctuations, the real-time fluctuations in the liquidity cycle have, generally speaking, historically been correlated with the lagged growth rate of total non-financial sector debt globally. This is the red line shows the total non-financial sector debt on a year-over-year rate of change basis with a 4.5-year lag to sort of simulate the early wave of the refinancing cycle. And so most of the time, the blue line and the red line are kind of, generally speaking, moving in the same direction. However, there are times where the blue line and the red line diverge enough materially to cause problems in asset markets. And this is sort of what you were alluding to. I believe you said Michael's commentary that the refinancing cycle can actually soak up liquidity as opposed to allowing that liquidity to capitalize higher prices and higher valuations across risk assets. And
exactly.
So that's what the red boxes, so these refinancing air pockets are what the red boxes are in this chart. If you look at the global financial crisis, we had a big divergence in the rate of change of liquidity relative to the rate of change of the lagged growth rate of debt. So we had a significant refinancing need, but we did not have the significant acceleration in liquidity to help capitalize that. We also had a very similar dynamic occur in 2011. Obviously, we had that was contributory to the European sovereign debt crisis. We had a similar dynamic occur in 2015 and 2016, which was contributory to let's say we had back-to-back like 15% declines in the S&P associated with the China devaluation of the yuan and the global corporate profit recession. Then we also had that in Q4 18, where we had an acceleration. It wasn't a significant acceleration, but we did have an acceleration in the world's total non-financial sector debt and a deceleration in liquidity. And then obviously we had that in 2022, which is one of the worst years ever in terms of the cumulative decline in both stocks and bonds. And so I'm concerned when I look at 2025 that we already have liquidity, the blue line, moving in the wrong direction, where we know we're going to have this massive acceleration in global refinancing demand. And so my concern as an investor, looking at 2025 is, okay, what if liquidity doesn't accelerate? Because I believe, some of the work I've seen from Michael Howe and our friend Raoul Paul over at Real Vision, some of their work would suggest, okay, because the red line is going up, the blue line has to go up. I don't necessarily share that view. Obviously I just highlighted, 4 or 5 different instances historically where the blue line did not go up and the red line, when the red line was accelerating markedly, and it caused significant problems in asset markets. And so my concern as an investor here in 2025 is, what if the blue line doesn't go up? And I think you have to be doubly concerned when you sort of look at our, stochastic forecasting of the liquidity cycle. We know what correlates with liquidity from a medium to, from a 3 and 6 month leading perspective. It's the rate of change of global stock market capitalization. It's the rate of change of crypto market capitalization. It's the dollar, it's currency volatility, it's global interest rates, bond market volatility, global growth, global inflation, and global unemployment. These are all the variables that have the highest predictive power over forecasting the rate of change of liquidity on a kind of medium-term time horizon. Let's call it the next 3 to 6 months. And when you run the math on those variables based on where they currently are, our model suggesting we could potentially see a significant decrease in the growth rate of global liquidity over the medium term. And so going back to this chart here, if we had a significant decrease in the blue line, where we know the red line is going up, this red box that I drew here is going to feel it to investors very similar to the other red boxes, which all, the smallest drawdown we saw was a back-to-back 15% declines. We had a couple of 20% declines. We had a 25% decline in the S&P, and then obviously the GFC, we had a 57% decline. Now, I'm not calling for a GFC or anything like that, but I do, again, believe you could have a, something that feels a lot like Q4 of 2018 or the summertime of 1998. In fact, I think 1998 is a perfect corollary for what we could potentially see here in 2025, which is a market that kind of rises, into the spring, aided and abetted by a Treasury General account spin down associated with the debt ceiling. There's about $650 billion in the Treasury General account currently. That's probably going to go towards zero in the coming months. That's supportive for asset markets. But beyond that, you're talking about refilling the TGA at the same time where you potentially have a decline in global liquidity and a significant global refinancing need. At the same time, we have a hawkish shift in net financing policy. And oh, by the way, our forecasts call for inflation to be accelerating appreciably by the middle of the year. So you can have a lot of bad stuff happen kind of in the summertime of this year that causes what we saw in 1998, which was a 19.5% decline in the S&P, very similar to Q4 18. But again, that dip got bought because the internet supercycle back then wasn't over. And then obviously you had fiscal discipline that was contributory to that as well. I don't know if we're going to get fiscal discipline in 2025, but you're going to get tax cuts and deregulation. And I wouldn't want to be short that heading into year end, but I do believe markets could potentially crash between now and then.
Okay. And you just answered then the follow-up question I was going to have, which is if you're looking at the liquidity line and the debt financing lines going in the opposite directions, in your chart there, it looks like that's something that plays out over quarters, maybe even a year plus. And so I was wondering, why are you still thinking, I want to buy this dip? Why wouldn't you be thinking we're going into a rough, maybe bear cycle? But it sounds like you're saying it's because you don't yet have data that suggests that the AI super cycle is over yet.
It's very unlikely that the AI super cycle is over this summer. I mean, again, I'm not an AI, I'm not an internet analyst or an AI analyst that'll by any stretch of imagination, but just relative to prior, big industrial cycles, when you compare it to things like the internet or the advent of the combustion engine or things of that nature, the railroads, these things are typically multiple years in time, not, year and a half, 2 years. So I would start there. But then when I go back and kind of answer your question specifically, the peak of this global refinancing demand, at least according to our model, is Q3 of 2025. In fact, September, in fact, is the peak month. So you kind of play this forward. Let's say this is mostly right. Like, again, I don't wake up with the assumption that everything I forecast is going to be accurate. I wake up with the ability to update my forecast from a Bayesian perspective based on new information. That's why I do my job every day for 12 to 15 hours. And so, but let's just assume a lot of what we've been talking about the potential risk of a global refinancing air pocket is accurate. And it does sort of that refinancing demand does peak in Q3. And we did have a crash in asset markets, let's say sometime starting in the spring and or summer, and that extended into the early to the late fall. The Fed is going to respond to a crash in the stock market and start to supply liquidity, as are the world's major central banks. So you could get to a scenario where we actually do get the public sector liquidity provision, but only after we actually test the strike price of the Fed put and the strike price of the PBOC put or the ECB put, et cetera, et cetera. So that, in my opinion, is how you could sort of wind up with an acceleration in liquidity. But again, right now, if you look at the leading indicators of liquidity, and again, this is back-tested math with decades of data, the leading indicators of liquidity imply there's a significant decrease coming over the medium term. And that is not good in the context of this chart, nor is it good in the context of this chart, which essentially shows you, it proves exactly what we're talking about with respect to those refinancing air pockets. So this chart, we show total non-financial sector debt on a nominal basis, with the red line is the S&P 500, the blue line is our global liquidity proxy. This panel shows the drawdown in total non-financial sector debt. This panel shows the drawdown in global liquidity, and this panel shows the drawdown in the S&P 500. Every single time we've had a significant drawdown in the S&P 500 since the start of the global financial crisis, it's come either in a global refinancing air pocket or a drawdown in global liquidity, or both. That's what the black dotted lines show in this. We had a refinancing air pocket and a decline in global liquidity in 2008, 2009. We had a refinancing air pocket in 2010. We had a refinancing air pocket in 2011. We had a refinancing air pocket and a decline in global liquidity in 2015, 2016. We had a refinancing air pocket in 2018. We had a decline in global liquidity during COVID. And then we had a refinancing air pocket and a decline in liquidity in 2022. And then we had a refinancing air pocket in 2023, summer of 2023. So you got to get this stuff right as an investor if you want to stay on the right side of market risk. If you're not using, systems like ours, like our KISS portfolio construction process or our discretionary risk management overlay to, you trend follow your way into the right answers. Because again, timing this, even if you're right on all the fundamental dynamics and you could still get the timing wrong, right? Let's say you did all this research and you said, okay, it's going to start exactly in late Q2 or early Q3, as Darius said. And what if it starts in April? You know what I mean? What if you're bullish in April because you think it's going to start 3 or 4 months from then? So that's the whole point of why we keep our risk management and our fundamental research process completely separate, right? I'm always going to do what our risk management systems are telling me to do, but ultimately we do all this fundamental research, which I believe, and obviously some very important people think is high quality fundamental research, so that we have confidence to execute on the systems when the systems signal a change.
All right, and we're going to get to your keep it simple in just a moment here, so folks don't worry, we're getting to that. So Darius, real quick, I should have asked this question earlier, but for your model, your Bayesian approach, I know I've asked you this in the past, but I just want to make sure viewers hear it. What is the sweet spot in terms of time projected out where your confidence is the highest, right?
Are you referring to our risk management overlays, or are you referring to our fundamental research process?
Yeah, I'm sorry. I'm talking like when you're looking at the markets and saying I think X is going to happen. Is sort of like 3 months. I think we did the analogy last time you were on, like the headlights of a car.
Yeah.
Right. It illuminates a certain amount of the road ahead of you with high confidence. Now, what's happening a mile or two beyond that, you don't really. You might have a general guess, but the model has much less confidence that far out. But within the headlights of the model, confidence is really high.
Yeah, I would say anything between 1 to 3 quarters is the maximum level of confidence. And anything beyond sort of 3 quarters, you start to lose a little bit of confidence. Like I have a lot more confidence in the next 2 quarters than I do, obviously, 6 quarters from now. But generally speaking, most of what I'm talking about from a growth, inflation, policy, or liquidity perspective is designed to help institutional investors manage risk on a 3 to 12 month time horizon, on a rolling 3 to 12 month time horizon. That's the 42 macro. That's the Darius Dale sweet spot for any time I'm having a conversation about fundamental dynamics in asset markets.
All right, perfect. Thank you. And again, this not why I asked, just wanted folks to have that in mind, but it also means that your appearance at the spring conference is going to be particularly important because we'll be getting into the headlight sweet spot of where you think the air pocket might lie by then. Okay. All right. Before we get to how the model is telling you to allocate now, given its outlook, let me ask you this question as well. So, you said understandably one of the big factors of uncertainty this year is going to be which policies that Trump has set forth is going to be implemented and to what degree, right? So I got a couple quick questions on that. So on the plus side, you mentioned tax cuts, deregulation, and boosting energy production.
Correct.
I didn't hear in there reducing government or increasing government efficiency or decreasing the size of government bureaucracy, which some people have tied to lowering the deficit. Do you have much expectations for DOGE and the impact of that? Do you have any expectations that deficit spending might actually materially change in 2025? Or do you just expect all that stuff, if it's going to do anything, it's going to be in future years?
Well, I mean, so it's I have high hopes and expectations for Doge, but the issue with respect to Doge is we are swimming, we're kind of swimming upstream, right? They have, so let's start and say they have to identify large categories, hundreds of billions of dollars of expenditure reductions out of the federal budget to use as offsets for what is an expansion of the extension and likely expansion of the Trump tax cuts. Right, they're going to use the reconciliation process to do so, and in order to survive the Senate reconciliation process, specifically the Byrd rule provisions, you can't have any sort of budget that sort of expands the deficit over a 10-year time horizon, and so they're going to have to find revenue offsets and expenditure reduction offsets for that. So I do believe Doge is going to come in and do some things. Sorry. However, as it relates specifically to deficit reduction, I'm not so sure they're going to achieve significant deficit reduction. They might achieve significant expenditure reduction, but don't forget, we're talking about an extension and expansion of the Trump tax cuts. And, again, you can argue whether or not the Committee for Responsible Federal Budget, which through our research we determine is the most bipartisan budget think tank down in DC, they're essentially saying that you're talking about somewhere between $3 to $5 trillion of additional deficits just from extending and expanding the Trump tax cuts. Now, the Republicans will tell you, they'll dynamic score it and everything is all be great. And in fact, that'll go down because we're cutting revenues. I don't buy that. You and I talked about this last time about how, that's all Republican propaganda. Every single Republican president in the post-war era has grown the debt. And in fact, if you look at the presidents that have grown the debt the most, 7 of the top 9 presidents in the post-war U.S. economy, as it relates to growing the debt, the percentage nominal change in the debt, have been Republican presidents, including the poster boy of quote unquote growing your way out of the debt, which is Ronald Reagan. So he's at the top of the list. He's number 1 and number 2 on the list, his first and second terms. So we don't buy the dynamic scoring argument. I don't think anyone should buy the dynamic scoring argument because there's no historical evidence of growing our way out of the debt, certainly not in the post-war U.S. economy, but that's neither here nor there as it relates to this. Going back to this discussion with respect to Doge, we know there are whole large categories of federal expenditures that Doge is that have been ring fenced from Doge, right? They're not going to touch Social Security. They're not going to touch Medicare. They're probably not going to touch, they're going to try to means test Medicaid and welfare and other entitlement, mandatory spending. But it's unclear to me how much you can have a significant change to those programs and also maintain sort of the populist spirit of the populist movement that has really supported and made President Trump so famous. So I think they're going to find it very difficult to achieve like the two. In fact, Elon he came out last week and confirmed which is something we talked about with our friend Luke Groman over at Forest for the Trees back in early December. We essentially said there's no way, Jose, they're going to get to $2 trillion, maybe $1 trillion, but probably not even that. And so when you look at borrowing the Luke's true interest expense metric, which is the Medicare, national defense, net interest, and Social Security, when you combine those 4 categories, you're talking about $4.2 trillion of expenditures, 61% of total expenditures, 14% of nominal GDP. It's grown 11%, 17%, and 13% over the past 3 years, with a trailing 3-year CAGR of plus 13%. Everything else in the federal budget, which is about 39% of the federal budget, or $2.7 trillion, has grown at a CAGR of minus 12% over the past 3 years. So they're going to have to take a gigantic chainsaw to the whole categories that these non-ring fence categories, of which that they currently comprise 39% of the federal budget. And by the way, one final thing I'll say is we know net interest is going to increase pretty markedly over the next 12 months as well. We got another $131 billion of additional net interest coming down the pike over the next 12 months based on the approximate next 12-month treasury supply we're going to see. Just basically, essentially, from refinancing the maturing debt into a higher interest rate regime, it's going to cost us about an additional $131 billion. And how do we determine that? That's the debt that's maturing over the next 12 months. We annualize the fiscal year-to-date budget deficit, and then we annualize the rate of divestment of the Fed's treasury portfolio, and we wind up with this kind of $12.5 trillion number. Now, I think the annualized rate of the fiscal year-to-date budget deficit is a bit high right now. So even if it's only 11.5, you were still talking about $125 billion of additional interest expense. And one final thing I'll say is, going back to this, global refinancing air pocket, you have a record amount of, sort of U.S. marketable treasury supply hitting the tape here in 2025, at the same time where you have a Federal Reserve that might be getting forced by reported inflation to get even less dovish, or potentially even completely neutral from the perspective of its reaction function. And you also have, this potential refinance, this could potentially weigh on the global liquidity from the perspective of the hawkish shift in net financing policy towards coupons. To me, I just think there's a lot of stuff that could go wrong, in 2025, and that's not great in the context of where we currently are in the positioning cycle, which is, again, going back to that extreme bullish positioning that we currently have.
Yeah. Okay. So two things that you're validating for me. One is that it's cooled off very slightly, but when you look at market valuations, almost every valuation metric you look at, they're near all-time highs. Some are at all-time record highs. Investor euphoria is off the charts by a lot of different measures. Sounds like you're corroborating that the market is just far too bullish for the uncertainty that you see lying ahead. I was going to ask you, and I still will, just in case there's anything else you want to mention there. You were talking there about how national net interest, debt interest service is going to continue to rise given all the treasury refinancing or treasury issuance we have to do this year.
Second biggest category of debt, or of our federal expenditures by the end of the year.
Right. So, we as best we can tell right now, higher for longer is going to continue this year, right? So, going through 2024, especially based on the initial expectations that Powell was setting. Hey, inflation, folks, we got it under control. We're back to rate cutting. Now inflation's proving really sticky. The Fed's beginning to say, we got to start slowing our roll here. Obviously, as the Fed has started cutting, the bond market has been taking yields in the other direction. So we're going to be hovering, hopefully. I mean, that's a good scenario, it seems, if we only hover and not continue to go up. Yields are going to be higher going forward than folks expected. And that, like as I said earlier, is going to continue to pull on the economy. And for as long as we can tell, in the near term at least, inflation is going to be sticky. Well,
time out. That's a loaded statement, Adam, because I don't know if everyone agrees with that. In fact, if you look at Bloomberg consensus estimates, no one agrees with that. Can I let me show you? Let's have a quick conversation about inflation.
Please, let's do. And and the day we're talking to, the new inflation data came out, and it was a tiny bit better than folks thought, and the market's rallying today. But let me put it this way: a lot of people were expecting that Powell would have, be doing a victory lap now in 2025, and instead they're having to backpedal, as you said. So nobody can claim that inflation looks like it's going to be solved in the next quarter or two.
No. And in fact, I would argue the victory lap is over. If you look at, according to our estimates, the victory lap that started on September 18th and ended on December 18th of 2024. So what we try to do in this model, we're trying to forecast growth and inflation, and then compare our forecast and the reported data relative to consensus estimates. Specifically, if you look at the chart down here on inflation, that we have inflation kind of meandering higher of the first 4 or 5 months of the year, but finally starting to kind of accelerate markedly in the kind of June, July timeframe. The consensus has inflation going down and down and down, has a little bit of a lift in that same time frame, but then going back down. if the blue line, which are the 42 macro forecasts, are more in line with what is ultimately reported, and the red line has to catch up or is just generally persistently surprised to the upside, then in our opinion, we're talking about a much more different reaction function out of the Federal Reserve, which is right now is, they're guiding to, if you look at the median FOMC participant dot plot, it's, a 3% neutral rate. So they currently think the 4.5% Fed funds rate is about 150 basis points above neutral. If inflation starts to accelerate, in accordance with our model, again, this is kind of a late Q2, early Q3 thing when it'll start to be more obvious to investors if our model is correct. And now that's a big if, but if our model is correct, then you're talking about a Federal Reserve that's going to say, hey, maybe 3% isn't neutral. Maybe neutral is probably closer to 4, or maybe where we even have it today, which is something we would argue is more likely to be accurate, just based on our projections of how resilient the economy has been. And when you look at some of the high frequency data, leading indicators from high frequency data are consistent with our belief that inflation is kind of bottoming at a level that's inconsistent with this 2% inflation target. If you look at the 1-year CPI expectation from the University of Michigan survey, accelerated 3.3%. That number is well above the pre-COVID trend of 2.6%. The 5 to 10-year University of Michigan survey accelerated to a new high of 3.3%. That's the highest level we've seen since July of 2008, well north of the pre-COVID trend of 2.5%. The ISM, the NFIB inflation indices are still well north of their pre-COVID trends and starting to bottom and reaccelerate. If you look at the ISM services prices PMI, that actually caused some consternation in markets last week, bounced up to 64.4, well north of the pre-COVID trend. These data points are suggestive that inflation is probably bottoming here in the kind of high 2s, low 3s, at least for this, next, few quarters and maybe a couple of years before we can ultimately get back to 2%. If you look at core PPI, which has been a leading indicator in this cycle, specifically, it started to break down, let's call it about a year and a half ahead of core CPI and core PCE. Core PPI bottomed a year ago in December 2023 and has been trending higher ever since. And so you're starting to see, core CPI, core PCE kind of look like they want to bottom at levels that are inconsistent with 2% as well. And so, this is all consistent with where we've been in our research since January of 2022, specifically as it relates to our secular inflation, our sticky inflation theme. Our secular inflation model, which interpolates the normalized change of all these key indicators of inflation back upon the underlying trend of the core PCE time series. Our model suggesting that the equilibrium level of core PCE in the current United States economy is somewhere between 2.9 and 3.2%. It's currently at 2.8% today. And so that would suggest that, okay, if that's correct, if this model is anywhere in the area code correct, and by the way, it's been saying that since January of 2022, if this model is correct, then we're talking about, a neutral policy rate that is just much higher than the median FOMC participant thinks it is today. And if we have to go to a state where they think it's higher, that represents a further hawkish repricing in the bond market. And finally, I'll shut up and kind of end on this point. If you look at the bond market is likely underpricing these structural tailwinds for supply in the context of what is, at the bare minimum, not a significant deficit reduction because you have tax cuts offsetting some of the Doge cuts, what could potentially be a significant deficit expansion if we just continue down the path of entitlement spending being driven by demographics, compounding, the categories that we know aren't going to be cut are still compounding at 13% per annum. If they just keep compounding at 10+% per annum, we know the deficit's going to continue to expand over the long term and debt's going to continue to accumulate. And so if we have these structural tailwinds for supply, that ultimately means the bond market is mispricing inflation. And how do we determine that? We look at the 10-year Treasury term premia, which is the excess return investors get for taking on the liquidity risk in the bond market. So instead of rolling over bills for 10 years, what's the excess yield you get just by being long a 10-year Treasury for 10 years? If you subtract the deviation from the long run mean of around 150 basis points in term premium from the current level of interest rates, you can get to what a normalized bond market interest rate would be. And the my model is suggesting that's somewhere around 5.46%. So if we had a 10-year nominal Treasury yield at 5.46%, assuming no change to the current TIPS yield, you're talking about inflation pricing in the threes and right around 3.25%, which is about 75 plus basis points higher than it currently being priced. And so in our opinion, this represents a significant downside risk in bond prices, significant upside risk in bond yields from here in the context of our sticky inflation thing becoming more true in the eyes of consensus, by the middle of this year or in the early part of Q3.
All right, you're doing a great job of asking the interviewers questions before he even the words come out of his mouth. So thank you. Yeah, that's fantastic. So basically, for the bond market, sounds like you're saying the beatings are going to continue for a good while here, if indeed your model proves to be correct.
They may not continue in a linear fashion, but I would expect the beating to accelerate. Again, late Q2, early Q3 is when the problems start happening. That's when you have the peak refinancing demand. That's when you potentially have an appreciable acceleration in inflation that causes consensus to get nervous about the Fed's reaction function, and it causes the Fed itself to get nervous about its reaction function. That stuff all starts to happen maybe starting late Q2, early Q3. So that's where I see the maximum amount of risk in asset markets this year. Now, could it start sooner than that? Of course, it could start sooner than that. Markets are smart; they're forward-looking. They may start to price these dynamics in ahead of time, but there's reasonable, there's reasons to believe that they don't have to now, largely driven by some of the TGA spin down, the resiliency of the economy persisting. I'm not smart enough to tell asset markets what they're going to do, but I am smart enough to understand what they might do and smart enough to build systems to keep me on the right side of risk when they do decide to price in different things.
Got it. Got it. And again, this is why, services like yours are so valuable, because as more data comes in, you can update in real time, and then the market will adjust and say, okay, hey, look, this risk we thought might happening, we're now actually beginning to see evidence that it might be in process, right?
Bingo.
So, high level, what I hear from you, Darius, is equity markets too euphoric, just richly priced, some may say overpriced, walking into some liquidity issues, and so therefore danger of an air pocket in equities at some point this year. And then I hear you saying bond market is mispricing both supply, future supply, and inflation expectations, or inflation, and therefore there's going to be a hawkish repricing in the bond market at some point too, if indeed your model proves to be correct. You're nodding as I'm saying this, but those are fair summaries.
Correct. Absolutely correct. And by the way, there's already been a hawkish repricing the bonds, right? Our Dr. Mo told our clients to sell bonds in September 17th. And ever since then, bonds have gone straight down in price. I want to say TLT is probably down, 16 to 17, 18% since then. It's largely been driven by an expansion of term premia, which is supportive of our belief that, as much as we want to celebrate Doge, and I'm, as an American, you and I talked about the risk to US dollar hegemony and our exorbitant privilege in this particular forward turning. And so I'm, as an American, I'm a proud American that's celebrating Doge as a patriot. However, I believe the tax reduction portion of that, of the fiscal negotiation process, could actually render Doge largely toothless, right?
Mm-hmm.
If the net result is more deficits and more debt, then it's not doing what it's supposed to do, right? We need to move in the other direction.
Got it. All right. And that makes total sense. And one of the reasons why I'm underscoring all this is I would say still, and you sort of alluded to this earlier, of the experts I have on this channel, on most topics, there's sort of a general consensus, but still on inflation and the direction of bond yields is where I see the greatest differences. And, a frequent question from the audience is, okay, so it's been painful to hold, longer bonds right now. Are the beatings over, and is this a good time to get in and ride? If the Fed is correct and it gets inflation under control, bond yields will come down, especially if the Fed starts cutting again, and blah, 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 blah. Is this a good time to be getting into the long bond trade? What I hear you saying is probably not. Yeah, in the near term, anything can happen, but you think that there is this hawkish repricing still ahead, as the mispricing of supply and inflation has to be priced in. And so this would not be the time necessarily to go big long on a buy and hold strategy for long bonds.
Nope, not at all. And this is something that could take years to play out, Adam. We're currently at 65 basis points to 66 basis points on 10-year Treasury term premia, and just getting back to a normal level of term premia in this bond market, again, takes you to about 5.5% on the 10-year Treasury yield. And that, if we had 5.5% on the 10-year Treasury yield with no change in real interest rates, you're talking about inflation pricing of about 3.25. So that is an it. If you're going to be long bonds, wait for that process to happen. It could take multiple years to play out. It's already taken multiple years to play out. Don't forget, this process started in late 2021, the hawkish repricing of the Treasury market. It's still ongoing. We're still trying to figure out where do we ultimately settle out. In our opinion, it's not going to settle out until we get to a minimum, mean type level of term premium. Now, by the way, historically speaking, term premium is at its widest when inflation is high and fiscal dynamics are as, porous as they currently are and likely to be over the long term in the context of the true interest expense compounding at 10+% per annum, and the U.S. demographic factors likely causing that to accelerate over the long term. Don't forget if you look at the baseline relative to current law, the U.S.'s debt to GDP ratio is set to be 125% in 10 years time. And this assumes the Trump tax cuts, expire at the end of 2025. So if they expire at the end of 2025, we're still going to accelerate in debt to GDP terms to 125%. If you add them back and add everything that Donald Trump promised on the campaign trail, that 125% turns into 142% in 10 years time. Now, obviously, everything's promised on the campaign trail is not going to be true, and you also have revenue raising tariffs that'll raise revenue and DOGE cuts that'll reduce expenditures to some degree. So it's going to be somewhere between, in our opinion, 125% debt to GDP in 10 years time and 133% debt to GDP in 10 years time. And neither of those are great in the context of a bond market that is currently underpricing structural tailwinds for supply and potentially mispricing inflation. And one final thing I'll say on this bond conversation, if we're wrong that the bond market is not, mispricing inflation and supply, then it's really probably just underpricing structural tailwinds from growth. Right, like this chart shows the 3-month 10-year Treasury yield curve at 34 basis points wide. The historical mean of the 10-year 3-month 10-year Treasury yield curve is about 135 basis points wide. And so if we had a normally sloped yield curve, now different from term premium, we're talking about the term spread. If we had a normally sloped yield curve, you're talking about a 10-year Treasury nominal 10-year Treasury yield that's somewhere around 566 basis points. And if you actually just use the current level of inflation pricing and tried to add that to the TIPS yield or subtract that from the nominal rate to find what the appropriate TIPS yield would be, it's somewhere around 3.25. So obviously, no matter how you slice and dice it, whether it's either inflation is being mispriced because the term premium is too low, or the real interest rates are being mispriced because the yield curve is too negatively sloped. And so as an investor, both of those scenarios wind up with a 10-year Treasury yield that's north of 5.5%. So I wouldn't touch a bond until we see 5.5% on the long end of the bond. And it could even go beyond that. But again, this is a multi-year process that started in the second half of 2021 that may conclude, second half of 2026, 2027. So don't be in a hurry.
Okay, thank you. Very, very important perspective for folks to share, especially on this key issue. There's just a ton of questions about. All right, so we are now about to get to the payoff, which is what is your KISS model telling investors how to position right now. Its KISS is keep it simple and systematic. Systematic. Got it. Okay, good. Before we get there, though, eagle-eyed viewers might have noticed in one of the charts you had earlier, and I can't remember the title of the chart, but I noticed in there. So last time we talked, which was at the fall conference in October, you said that we were back in Goldilocks, right? It looks like if I read your spreadsheet correctly there, we then moved into reflation right at the very end of 2024, and your model is now projecting an inflationary regime basically from now up until the headlight ends. Did I see that correctly? And more generally, what regime does your model have us in right now?
Yeah. So you're thinking of you're talking about the model where we had a growth and inflation projected?
Yes, I think so.
Let me show you that. Yeah. Are you talking about this model here? Where we have inflation.
Yeah. So I was looking at the 42 macro line there.
Yeah, exactly. So if you're asking what the economy is doing, the economy is currently in inflation, is likely to remain in inflation at least over the duration of our next 12-month forecast horizon. That's growth slowing and inflation trending higher. So growth trending lower and inflation trending higher. And so this is what the economy is doing. And the reason we use this model to assess the probability of regime change in asset markets is because a lot of times asset markets are generally pricing in growth and inflation dynamics. And then every once in a while, whenever we have a significant change in the liquidity cycle, either inflection to the downside or to the upside, then liquidity will become the main focus of asset markets. And then obviously you have big changes in monetary and fiscal policy that could potentially cause that. And so this tells you that the baseline, the baseline, the belief system of the median investor across asset markets as we go through time, will see data that's trending lower on the growth side and data that's trending higher on the inflation side. And they're probably going to get more skittish in the context of what that ultimately implies for liquidity. when you go back and you talk about our KISS portfolio construction process, Adam, what our KISS portfolio construction process is designed to do is take our market regime nowcasting process. So we run two separate processes. One, the what is the economy trying to price or trying to do from a growth and inflation standpoint? And then what is the market, what are markets currently pricing in? They might be pricing in the same thing that the economy is doing, or they may be pricing in something different from the perspective of liquidity. It either or, it doesn't make a difference to me. What matters most is what is the market trying to price in and participating in that. By the way, dirty little tip here, pro tip, everyone grab your pen and take notes if you haven't been already. You make money as an investor by participating in what the market is trying to price in. You don't make money as an investor by putting on positions and telling the market what it has to price in. The market doesn't have to price in your thesis. The market is going to price in whatever it prices in. So if you want to make money as an investor, you need to be water and just accept that and position for what the market is trying to price in. And that's exactly why we built our KISS portfolio construction process, Adam, which is to help investors do exactly that, with three simple ETFs: SPY, IAU, and FBTC. So stocks, gold, and Bitcoin are the three exposures here. And just I'll give you a quick little 30-second rundown on this, because I'm sure we went through it in more detail last time. Definitely check that out if you're new to this conversation and you want to get a little bit more detail on our KISS process. But KISS is designed, it's a trend following strategy that is designed to outperform the 60/40 portfolio through three lenses, through three dimensions. One, factor selection. So instead of having 40% of our assets, tethered to the bond market, which we think could continue to blow up over the long term, we actually allocate 30% to gold and 10% to Bitcoin. And then we incorporate volatility targeting, which is one of the hallmarks of institutional finance and risk management, into the strategy using our market regime nowcasting process. And then we incorporate dynamic position sizing into the strategy using our volatility adjusted momentum signal for each of those ETFs, stocks, or SPY, IEU, and FBTC. And the quick takeaway here, before we get into the current allocation, is when you look at this on an out of sample backtest basis, and this backtest starts in January of 2018, and all the trades are lagged to, relative to when the signals are generated. So you can, simulate this is a very, serious out of sample institutional grade backtest. And what the average annual return is in those assets in this strategy is about 20%, with a maximum drawdown of minus 11%. If you wanted to compare that to 60/40, the average annual return of 60/40 is only 9%, so less than half, and the max drawdown is minus 22%, so double. And if you wanted to run 60% stocks, 30% gold, and 10% Bitcoin without the benefit of our volatility targeting and our dynamic position sizing elements, which create the trend following strategy, then you'd have a similar average annual return, but you'd have a significantly worse performance in terms of the max drawdown and the volatility. In fact, you would have crashed 3 times 60% stocks, gold, and Bitcoin over the past kind of 6-7 years if you didn't have our trend following elements in this process. But the trend following elements are what gets you a max drawdown of only 11%, and it's the only double-digit drawdown in the sample. So getting into the current allocation is a bit nervous. It's a bit skittish. It mirrors a lot of what we've talked about today, Adam, about how the distribution of probable outcomes is wide and widening, and that ultimately means the left tail, that left tail of the distribution is now starting to get a lot more area under the curve than it had when we were ragingly bullish for last year and bullish for 2023. And so right now we are currently at 52% cash. We're at 30%, 50% of our maximum exposure, 60% in stocks vis-a-vis the SPY ETF. We're at 50% of our maximum exposure in gold vis-a-vis 50% of our maximum exposure of 30% in gold vis-a-vis the IAU ETF. And they were only at 25% of our maximum exposure of 10% in Bitcoin vis-a-vis the FBTC ETF. So the trend following elements of this strategy took us from being fully invested, which we were for most of 2024 and 2023, to a lot less invested, which is where we are today.
All right. Yes. When we talked in October, you were at 0% cash and 100% all the others.
Yep.
Yeah. Or 100% of their allocations, right? So obviously you have become a lot more defensive, and the proof is in the pudding, right? They always say, don't listen to what people say, listen to what they do. And people should listen to what you say, Darius, but watching what you do is you are definitely tapping the brakes, fairly substantially here. Now, obviously, you still have almost half your portfolio long here, so this isn't a get out of the pool moment, but it's I'm going to start dancing at the edge of the dance floor moment. Maybe, is that fair to say?
100%, Adam. 100%. This is you're in a crowded movie theater and you're like, it smells a little funny in here. As opposed to instead of sitting in the middle of the theater, let me just grab a seat next to the aisle, right? Let me get an aisle seat. This is me getting an aisle. This is our KISS strategy, grabbing an aisle seat. Now the movie may persist, and I generally expect the movie to persist, until the springtime or even into the late, early summer. But again, in our opinion, it's hard. It's going to be hard for asset markets not to have a serious correction in 2025. Whether that serious correction is 10% or 20% depends on, the liquidity conditions at the time. And we created a very, very data driven, high quality scenario of how those liquidity conditions could actually contribute to something that's on the deeper end of that range in terms of being down 20%. And so, yeah, I would expect, this system to kind of hang out somewhere between, let's call it, again, I don't predict the system. Again, let me make sure be very clear about that. This is a completely systematic system that is being driven by quantitative signals. There's no element of my thoughts in this system. And oh, by the way, as it relates to should you listen to Darius or not, Darius Dale uses this system to manage his entire liquid net worth. So, going back into this analogy, we're grabbing a movie seat, we're still eating popcorn. I think we're probably hang out somewhere between 25 and 50% cash between now and let's call it middle of the year. But I would imagine at some point, if we're right about a lot of the things that we talked about with respect to the global refinancing air pocket, with respect to a hawkish shift in Treasury net financing policy, with respect to a potential upside surprises in inflation, with respect to potential how those upside surprises in inflation may contribute to a shift in the Fed's reaction function. Man, in the context of this asymmetric bullish positioning that we talked about at the beginning of the conversation, I got to imagine that this system is going to be at 100% cash at some point this year, heading into a drawdown or crash. And so that's me predicting the predictors. Our clients are going to slap me on the wrist for that. And so, ultimately, my prediction of the predictors has no bearing on the process. But that's just me trying to, kind of paint it out and give you guys a little bit more of a high quality overview of what we think it might happen in 2025.
Got it. Right. That's Darius Dale's best educated guess, but obviously the model's going to tell you what to do. So, okay, Darius, you're still watching the movie. You're still even eating some popcorn, but you moved to an aisle seat. You're looking down. You're making sure your shoelaces are tied just in case you start sprinting. 100%. But okay. All right. Well, let me say this. So you expect this air pocket, as you said, you wouldn't surprise you at all. In fact, your default expectation is at some point this year, that model is going to be 100% cash. What are the things that you're going to be looking at that will tell you, okay, Darius, now it's time to start going to more total cash?
Yeah. So going back to that process, the volatility targeting component uses our market regime nowcasting process to infuse the vol targeting to shrink the target allocations in accordance with the expected path for volatility in each of those assets. And so going into a risk off market regime and staying there will, reduce our target allocation. And then once those securities start to change from the perspective of their own volatility adjusted momentum signals, i.e. they're bullish, and if they start to go to neutral and maybe even bearish, that'll start to take us down from 50% of the target allocation to 0% of the target allocation. That's one of the rules in the system. Going back to the slide here. If let's say for example we're in a risk off market regime, the target allocation for stocks is not 60% like it would be in a risk on market regime. It actually gets cut in half to 30%. And if the stock market goes from bullish to neutral, then the actual exposure, the exposure you feel in your portfolio that's represented here in this pie chart will actually only be half of that. And so, that's how you can get, cash raising, pretty substantially going into a risk off market regime and the securities themselves starting to break down from the perspective of their individual volatility adjusted momentum signals. So it's a complicated system in terms of its design, but it's an incredibly simple system in terms of its execution. Right? You're only using 3 ETFs to manage your entire portfolio at any given time. And it's a really effective system, as evidenced by the back test and as evidenced by our thousands of very happy clients.
All right, folks. Well, look, if you've been a regular viewer of this channel, you know what I talked about earlier, which is that Darius has one of the best track records in recent years, at minimum, of sort of accurately divining where the markets are headed. So he's definitely a voice we should be listening to. That voice is becoming notably less optimistic about the markets as it has been in the past couple of years. So that's very meaningful. If folks want to start actually guiding their own investment decisions by your data here, Darius, where should they go to learn more about you and your work?
Oh, I really appreciate that, Adam. And again, thank you again. I love partnering with you. I think you and I share the similar mission in terms of, narrowing that information asymmetry between, our top end institutional clients on global Wall Street and our Main Street investors, who I care deeply and passionately about as well. So if we impressed you, if you think we can help, to help your portfolio stay on the right side of market risk, definitely come check us out at 42macro.com. We actually, we finished our client testimonials page. So that's 42macro.com/testimonials. Definitely check that out. I mean, there are literally hundreds of testimonials on that page from our clients spanning several years, essentially saying exactly what we've been talking about, which is, I think we do a pretty good job of keeping our clients on the right side of market risk in both bull markets and bear markets. And I think, we could potentially see a very short and sweet bear market here in 2025, but ultimately resolving itself back into a bull, headed into year end. Because again, I don't think AI super cycle is done. I don't think tax cuts and deregulation or something is structurally short. So ultimately, I do believe the dip will be bought, but I think the dip could be pretty serious. And if you're on the wrong side of that dip, you could be quite painful.
All right. Well, look, my friend, when I edit this, I will put up the links to your website there so folks know to go. Folks, there'll be a link in the description below this video as well if you want to just get there with one click. Darius, hang out just for 1 second. I got or 30 seconds. I got 30 seconds of house cleaning, and then I want to give you the last word. So folks, if you've enjoyed having Darius on here, and how could you not, such a fantastic discussion, please let him know by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Again, if you're a DIY investor, many reasons that Darius has already proven many times in this conversation why you should seriously consider thinking about signing up for 42 Macro. It is a highly data-driven, near-term, highly successful, and implementation-wise, highly easy framework to employ. But if you're somebody that wants a little bit more help, maybe you want, you want to outsource to a financial quarterback to handle all this for you. Highly recommend that you work under the guidance of a good professional financial advisor who takes into account all the macro issues that Darius and the team at 42 Macro does. If you've got a good one who can do that for you, great, stick with them. But if you don't, consider talking with one of the financial advisors that Thoughtful Money endorses. They're the firms you see with me on this channel. Tell them, hey, look, I'm really impressed by Darius. I want help doing that. They will be happy to do their best there as they can. So anyways, fill out the form there at thoughtfulmoney.com. Only takes you a couple of seconds. The firms will be in touch right away. These consultations are totally free. There's no commitment to work with them. It's just them trying to be as helpful to you as they can be. All right, now Darius, I don't want to put a lot of pressure on you, but a couple of times you've been on here, you have definitely delivered some, I think very powerful and very inspirational in many ways, thoughts on kind of, how you're seeing us progress in this sort of fourth turning that the world is entering into here. No pressure to have to match your prior soliloquies on this, but is there anything that is really at the center of your focus right now that I wasn't wise enough to ask you about in this conversation so far?
Ooh, at this, well, no, because we talked about the changes to fiscal policy and the impact that Doge may have relative to the impact of the tax cuts, et cetera. I would say no on that particular question. But the one thing I will say is, holy cow, if you don't believe by now that we are in a fourth turning, you're never going to believe it. I mean, we just had a president and a Congress get elected with a change mandate, a significant institutional change mandate. We're hearing proposals about potentially reformulating the global currency system, reformulating the global trade system, reformulating how the Federal Reserve is structured and what they're and how that's going to impact the economy and markets. There's a lot of change coming down the pike. And the one final thing I'll say on all this change is, again, some of the change will be good, some of the change will be bad. I think we're going to have to learn together as investors and as people to figure that stuff out. But ultimately, I just really, I've been doing this for 16 years now, flying around global Wall Street, meeting with really, really smart investors, some of the world's best investors, many who are, you guys well know, you're seeing on TV, you see them in now very, very important public office.
Mm-hmm.
I don't think any of those people, or myself included, when I say those people, those institutional investors, thinks that we have the ability to accurately forecast all this change, nor do we think we have the ability to accurately position for all this change and remain on the right side of market risk. So if you're investor spending, 1/10 the amount of time that we are with, some fraction of the training and experience, boy, I think there's just a lot of hubris in that belief system. So I would really, if I could just leave you guys all at one thing, it's just respect that you're going to need a lot more humility to survive as an investor, to remain on the right side of market risk over the medium to long term. And in my opinion, that's why we shifted our entire risk management process going back to late 2022 to our entire trend following elements. We only follow trends here at 42 Macro. I don't predict where markets are going to be in position for them, nor do I to instruct our clients to do that, because I think that's a really dangerous thing to do, especially in a fourth turning with all this change.
Got it. So you're being water, as you said earlier,
Which, by the way, it doesn't imply a lot of trading. We didn't trade a lot in 2024. We just rode a raging bull market that we predicted.
Right. And if it's working for you, why change it?
Right?
So you didn't say this specifically, but I'm going to say it for you, which is, given all this, relatively, I don't want to say unprecedented, because we've been through other fourth turnings as a society, but we as a living populace haven't been through one before, right? So given this unusually extreme amount of change going on, for most people, it's time to call on the professionals, right? In other words, unless you feel that you've got a framework that's going to beat the top 10% of professionals that are out there competing against you on a daily basis, and have greater networks, quantitative models. I mean, just all sorts of other advantages that you don't as the individual investor here. We're entering such a potentially turbulent time here, or likely to be turbulent time, that just to kind of soldier it alone as you are trying to live your life and focus on your job. And to your point, as you said, Darius, maybe only giving 1/10 or less of the attention that someone who's focused on this all the time can give it. You got to be really honest with yourself and say, what are my odds, right? So obviously do whatever you think is going to put your odds in the best position. But for a lot of people, that's going to be following a really good professional like you and the team at 42 Macro. So I'm just going to put it out there that directly for folks. All right, Darius, well, look, the last question on this.
Can I say one quick thing on that?
Yeah.
Make sure if you start liaisoning with professionals that they're not these kind of professionals, because there's two types of professionals out there. There's the professionals that are doing exactly what I'm warning you not to do, which is think you can predict all this stuff consistently and accurately and use those predictions to manage risk in your portfolio. I'm essentially saying, based on the widening distribution of probable economic outcomes, that is both a function of the fiscal and regulatory policy changes, but also the forward turning, that it's going to be basically impossible for mere mortals to do that, including myself. And so if you're going to be liaisoning with professionals, make sure that they're the kind of professionals that understand the value of trend following systems, the value of not trying to predict everything, but just responding to market signals, listening to the market. Listen to the market. That's the most important thing you're going to learn from this entire discussion today, is listen to the market.
It's so well said. I can't add anything to it except just to say I love the analogy you had there of the old MapQuest directions versus the new whatever. But think of it like Waze, right? Like I could either print out directions, okay, I got to turn left here, turn right here, or hey, accident up ahead, go through this detour, right? We're going to be in that type of world where there's just going to be so many different changes, curveballs, et cetera, that we want to be, to your analogy, water just flowing to where it needs to go versus following a playbook that may actually be erroneous or just very bad fit for the unfolding real-time developments in front of us.
100%. Couldn't have said it better myself.
All right. So last question before turning, I'll let you go, and I appreciate you going along here. So when people think about the fourth turning, and you and I, both know Neil Howe and have spent a lot of time talking with him, I think most people think, all right, previous fourth turnings, American Revolution, Civil War, World War II, there's some point at which you kind of get to this flashpoint where, the torches and pitchforks come out, more or less. We have had this was kind of a bonkers presidential election. So many different things happened that haven't happened in living memory. It was crazy. But, it went so far, relatively peacefully, and a lot of folks have a lot of optimism for where the new administration may take things. Not everyone, but a lot do. Do you think before this fourth turning is over, there is going to be more of a pitchforks and torches moment, or is the worst of the social disruption behind us at this point, do you think?
Oh no, the worst of the social disruption is very unlikely to be behind us, just based on where we are in the fourth turning cycle.
Yeah.
You typically have a big consolidation towards the end of the fourth turning that ultimately, where the battle lines are drawn, and then we have the battle, the crisis. Neil himself, the godfather of the fourth turning, the author of this framework, would tell you today, as one of my mentors and a friend, he doesn't know what that consolidation crisis moment will be. I happen to think it could be any number of things. I think it's easy to think, war, civil war, global war, total war. But I think there's also, we have fires raging in California, obviously, and obviously our hearts and prayers out to everyone impacted by that right now. It could be a climate change crisis that accelerates materially, that requires a complete mobilization of public sector resources. I said this last time we were on the program. There's an asteroid, very large one, comet coming in between the moon and the earth in 2029. Right? What if that thing's actually on its way to hit us? So we have all kinds of things that could actually create this, mobilization of public sector resources where we actually need to, kind of fight for our existential survival. I don't know what the answer is. I don't think anybody knows what the answer is, but I do know that based on the evolution of the economic dynamics and political dynamics that we've seen in this country over the past 10 to 15 years, that we are marching right along according to the historical fourth turning playbook. Go read the books if you don't believe what we're talking about. The hair on the back of your neck will stand up based on how prescient the 1997 book was and how well researched the 2023 version was.
I totally agree, and you reminded me, and it's been a little while since I've had Neil on, so I'm writing here. I'm going to reach out to him and see if I can get him on in the next couple of months. But key takeaway, and the reason why I asked the question was, what I hear you saying to folks is, don't stand down. Don't get complacent here. That things are likely to probably get even more uncertain in future years coming forward here as this fourth turning continues to unfold. So stay vigilant.
Yeah. By the way, I'm raging bullish because of the fourth turning. Historically speaking, one thing you get in fourth turnings is fiscal dominance, and it's our belief that the Fed is going to be forced to capitalize the fiscal situation. So we're ragingly bullish as a function of these fourth turnings because, historically speaking, the response to fiscal dominance is monetary debasement and financial repression. So what you have to expect as an investor is you're going to continue to see these leptocratic outcomes in financial markets, raging bull markets, big bear markets when we have liquidity air pocket or the Fed's not doing enough to capitalize the fiscal situation. But generally speaking, as an investor, trying to time the leptocratic nature of markets, which, shout out to our friend Jim Carson over at Kai Volatility Advisors, who kind of coined this thought process a couple of years ago, which we heavily agree with. We just saw two back-to-back 20+% returns, year returns in the S&P 500. We could also have a 20% decline in the S&P 500 in 2025. This is exactly what leptocratic markets are, and this is exactly what you should expect in a fourth turning based on our deep dive empirical study of fourth turnings.
Okay. Really look forward to riding that opportunity along with you, Darius. FYI, folks, too, we're going to have Jim Carson on the show in a week or two as well. He's already booked. So great timely mention there, Darius. All right, Darius, well, look, I've kept you far too long, but for good reason. You just keep delivering pearls with every answer I ask you to give. Thank you so much. Thanks for giving so much time. Good luck to you in continuing to outperform for your clients here. Super well deserved, highly well earned by the really rigorous process and just honestly just hard daily commitment that you and the team there show in the field there at 42 Macro. It's always such a joy and a privilege to have you on the channel, buddy. Thank you so much.
Likewise, and thank you so much, man. I love what you're doing. Keep it up, and look forward to next time, brother. Thank you.
All right. Thanks so much. Everybody else, thanks so much for watching.